Fund Friday for standard online share trading. What we're going to be focusing on today is when funds change. And there's some nuances. There's in particular one that's important that we need to talk about. They announced it on Monday. That's the Ashburton 1200 Global. But I want to delve into just how that process works and what we are talking about when we mention funds changing and what we're not talking about, because some of the changes which you might think are changes might not necessarily be considered in terms of the collective investment scheme. And what's important is that this is overseen by the FSCA, Financial Services Conduct Authority. They will request a fund if they want to make changes. It needs to contact the FSCA, engage them in that process, and the FSCA will determine a ruling as to whether or not it needs to be an official change that needs to be balloted or not. And there's some important distinctions, as I mentioned, and it's also, this all falls under the Collective Investment Scheme Act. So this would include unit trusts, it will include hedge funds, and of course it would include exchange traded funds as well, ETFs. So whether they're active or passive, if they want to make a material mandate change, they need to ballot current holders of the fund. And this is for perfectly sensible reason. I mean, if you pause a moment, you've bought a fund, and whether it be a hedge fund, a unit trust, or an ETF, you've bought this fund under understanding of what that mandate would be. And if there's to be a material change to the mandate, well, then they need to, ask if they can. Now, of course, this is a balloting process, and I'll talk through the actual process in a moment. The balloting process might happen, and you might vote no, and the majority might vote yes, in which case, your option now is either to go with it or to exit. Inversely, you might vote yes, and the majority might vote no. But typically, the changes are going to be, fairly small. We're not going to see a pure equity fund suddenly become an income fund, for example. What we do see more often in the unit trust space is where funds essentially get merged. So you've got two funds and one gets folded into the other. We also see funds getting closed down. We've had a few ETFs closed down, and the closing down process does not require shareholder approval. There's again a regulated process that happens via the FSCA, but it's not requiring shareholder approval. That'll happen, but there needs to be timelines. And this is quite simply to protect the investors. What it does exclude is style drift. Now, this is quite important. Now, style drift, what I mean by style drift, if you've invested in a fund because it's got a certain type of methodology, maybe that's a value investing, maybe it's momentum, maybe it just, is a passive top 40 type of fund. And we will see, and we've seen a lot of it where value investors sort of become momentum investors, and I'm not going to name names, but with the style drifts where they start as one methodology but kind of shift along. But as long as the change is fairly nuanced, that distinction between value and momentum is nuanced. Now, in absolute, yes, we can sit down and we can distinguish between the two. But truthfully, you will often find value and momentum investors holding the same stocks. And of course, value as a concept, we can go back to Benjamin Graham and the Intelligent Investor, but there's many other ways to consider how to do it, how to do value. And all fund managers, and truthfully, are to some degree a value investor. So often it's a case of style drift, and that's really, really hard to notice. That's really, really hard to pick up. But that's not what we're talking about today. In an ideal world, a fund remains to their style. What we have seen in South Africa is, and Core Shares did it, so they're two property funds, they've essentially merged them together and changed the methodology. They're what was an equal weighted ETF, their Better Beta Smart equal weighted, or they became the Core Shares when they bought it from Nedbank. Again, they went from an equal weight to a multi-smart faceted methodology, and those both required ballots from users. What we're also not distinctioning with is that changes to the actual holdings. Your passive investors are typically changing the holdings. either quarterly, or perhaps sometimes it's going to be biannual, sometimes maybe even annually, as the indices rebalance. And that's not what we're talking here. And of course, your active fund managers are, just as it suggests, they are active in the process, and therefore they are engaging and changing shares on a fairly regular basis. So it's really when there's a significant change to the methodology that it becomes important, and that investors who are in the fund then get to vote. And remember, of course, you can vote, but you can also vote with your wallet in terms of that you can exit. The balloting process is quite clearly defined by the FSCA, Financial Conduct Services Authority, and what they do, it needs to be managed by a third party. So if I'm changing my fund, you don't tell me what you want. I need to set up a third party to manage this process. That third party is going to be auditors, one of the big audit groups, and they will then contact all the current holders. They will contact those current holders via your stockbroker or your CSDP. So if you hold them within ASI and within Standard Bank or within online share trading, you will get contacted in order to go and have your say and actually manage that process. And these days, OST's got an electronic process. Sorry, next screen. OST's got an electronic process. We'll touch on that in a moment. So you'll be contacted to vote your unit that you are holding. Now, this is obviously an example of an exchange traded fund that we are talking about. Unit trusts will contact you. Typically, you're buying those via a LISP process, and they will have their own mechanisms for doing it. But you'll be contacted by that third party in terms of what your vote is. The entire process runs about a month, maybe a little over, maybe in total, from announcement to conclusion of the voting process, probably 6 weeks, and then it's announced, and then a week later, it will effectively happen. That is assuming that the balloting process went in favor of the process. It starts with a sense being issued in case of an ETF. They then start the ballot process, they receive and they confirm the votes, and then if it has been confirmed, the changes are made. There is an important component. It is a simple majority rule, but 25% of holders need to vote. And if they don't get 25% of holders of the ETF voting or the unit trust or whatever it is, then quite simply, it doesn't matter what the vote was, it needs to be reheld. So if you've got 25% plus one of the votes being voted on, then majority rules. And if there is, if the majority is yay or nay, then that is how it will work. Typically, if it's a nay, we haven't had an example of that, but if there was a nay, then usually that particular product would just close itself down and then restart. Now, there has been a lot of debate around, particularly the core shares, of why not just close a product and restart a product? And that's not an unrealistic question. I mean, the property ones with core shares made a lot of sense in that it was really, they were sitting on an equal weight top 10 and then a SAPI, South African Property Index, two different ETFs, and they wanted to merge them together under their own methodology. And you were still invested in property, just with a slightly different focus and a slightly bigger range of shares. In the case of, and in particular note was that you included was then the offshore or the inward listed. In the case of the beta beta change, there was a fairly material change in that you went from a fairly dumb, sort of equal weight process to I think 5 or 6 smart factors in the process. That was fairly significant. And the logic behind the likes of core shares and the like, and there have been others who've done the changes, is that you've already got an asset base there, you've already got users, assets under management, convert rather than close and open. And that's the debate we can have forever and a day, but certainly that's how it stands. So the first vote needs 25% essentially attendance at the vote, although of course it's virtual, and then majority wins. If they don't get 25%, they then hold a second vote, and then again, it is a case of majority carries the day. So it is a majority win, but the first time, and this is FSCA trying to make sure that there's significant active participation. It also sort of helps ensure that the managers of the fund sort of don't just kind of slip it under and, and issue an announcement, but kind of do it at the dark of night and don't really get it out there. If they do that, they're just not going to get their 25%. They're going to have to hold a second round. Importantly, the cost of this process is borne by the management company, not by the fund itself. So it's not onerous to us in that particular case. And then the reason I wanted to bring this up this morning is because an ETF which I hold, the ASHGEQ, is doing a ballot process to change their portfolio. And how this works, it was announced Monday just gone. What they do is this is their 1200 global 1200. It's the S&P 1200 global index. I like it because not only is it global, so it slightly downweights your exposure to the US, upweights some exposure into Europe and the like. Now, if you hold an S&P 500 and you do a look through, as I've always said, you're getting exposure to non-US. Even with the MSCI Global Developed Index, and the example I use is Apple. Biggest stock in both of those indices, and in fact biggest in the ASHGEQ 1200 as well. But Apple, of course, is not only selling Apple product in America. I'm presenting this on an Apple product, and I live in what we call an emerging market, otherwise known as South Africa. But what I like about the ASHGEQ is that it also has about a 7% holding into emerging markets, direct emerging markets. Now that excludes Africa. So it's going to be Latin America, it's going to be Asia, but we have enough Africa exposure due to our home bias, our Reg 28 products, etc., investing onto the JSE. So what the ASHGEQ 1200 changes, they currently buy about 800 of the shares, and then they put some ETFs into to make up the ultimate 1200 shares. But it's an expensive, cumbersome process, particularly because you're in a number of different markets, a number of different territories, currencies, and the like. The proposal is to instead just hold the 7 ETFs tracking those 7 different regions. And the one of those is the S&P 500, Europe and Australasia, and Asia, South America. And so it gives you exactly the same 1,200 shares. Instead of just holding some of them individually, what they do is they just buy that ETF. So it can reduce the costs for them. Essentially, what we end up with is a fund of funds. And not a fund of funds in the sense of, those horrible overpriced structures that we get sold by some financial advisors. This just happens to be an exchange-traded fund holding a bunch of other exchange-traded funds. We already have some what we call feeder funds on our market. For example, I think the Satrix S&P 500, they're not buying the 500 shares, they simply go and buy the iShares S&P 500. And the reason you do it is because those iShares ETFs have got such scale that they can do them at fractions of the price then Satrix can go and make those transactions. So it's just a much cheaper way to do it. And hence why ASHGEQ on their Global 1200 are wanting to do this and do this process. So ultimately, you end up with exactly the same 1,200 stocks, but instead of holding the ETF, which holds the stocks, you hold the ETF, which holds an ETF, which holds the stocks. And ironically, because you would think with layers and layers and layers that this would push the costs up, this actually brings the costs down. This ultimately makes it a cheaper ETF. In the case of the ASHGEQ, they're expecting it to drop from 0.67% total expense ratio, in fact, total investment cost, down to 0.49. So it's a 0.18% drop in terms of the fee. And the reason why fund holding funds, which you typically think is cheaper, as I said, those funds which they will then be investing into are massive and have got significant economics of scale. Some of their funds are coming in that they will invest into at sort of 0.04%. The cheapest we have on our market is 0.1. So we get those scales. In the case of the ASHGEQ, if you hold it as it close 25 June, you will be required to vote. That vote ends on 4 August, so it's running. It's actually running quite a chunky time. It's running almost 6 weeks. And of course, 25 June was yesterday. So if you hold it at close of yesterday, you've got until 4th of August to make your election. And online share trading, as I said, makes this deadly easy for us in that we can do it online. So they will send an email and say, hey, you've got an election to make. but if you you can go on to my account, electives and proxy events. And what you can do here is this is where you will vote yay or nay for the units you hold. Very importantly, it's per account. So if, for example, you have this ETF in both a tax-free account and a normal discretionary account, you will have to vote twice, because you've basically got two different accounts that you hold it in. Yes, you might be a single individual, but you've got two accounts that you hold it in and therefore need to vote it through. You don't have to vote. There is absolutely no requirement. And if you do vote, whether you vote yes or no is entirely up to you. It is your vote, and I suppose I was going to say your vote is secret within degrees. But it's your call as to whether or not you will or won't. Online share trading will take a week or so, 10 days to get the notification, to put the process up, and then we need to have voted by close on 4th of August. And online share trading sometimes brings that date a little forward just to make that end process smooth. Just a quick thing on the elective. Someone commented on the questions. Is this where we vote AGMs and the like? Absolutely. So anytime a company needs to essentially ballot shareholders, in this case, it's the Ashburton ETF changing, then they need to ballot. But it could be your votes at an AGM. It's exactly the same process. Sometimes a company will say, well, do you want cash for your dividend or do you want equity for your dividend? And again, you get to choose, and OST uses their elective and proxy events. And essentially, what you're doing is you're saying to online share trading, please vote me this way. They don't take any decision as to how to vote. They don't give you advice as how to vote. They are just facilitating the process. They then take all of their clients who then voted in one way and the clients who voted the other way. They take all of those votes, they record them, and they will then submit them to the managers of that ballot process. Or if it's an AGM, they submit them as a proxy vote to the annual general meeting, and people can then vote accordingly. Very important for the ASHGEQ, there will be a change to the code. And in fact, the historic data will disappear at the same time, because whilst this is truthfully, in some senses, a fairly small change, in that I'm going to be holding exactly the same 1,200 shares, just with an extra layer of funds in it, practically, it's a fairly fundamental change in that they've gone from a couple of ETFs and 800 shares to now just 7 ETFs. And one of the questions was why the vote? This change looks quite small and of benefit to unit holders. Yes, on a practical purpose, it is quite small because those 1,200 shares remain the same, and it is of benefit to the unit holders. Shabir, you're asking, how will I vote? I will vote yes. I've never found a fee that goes down that I didn't like. Lower fees are always better. And you know what? And I said this a lot of times. We're talking about 0.18% difference, which is tiny. I mean, let's be frank. But that's the world we live in these days, where 0.18%. Ashburton goes through this entire process just to save us, 18 points in it. Yeah, so it should be a good point. There's actually two parts to the drop. The one is that Ashburton is effectively reducing their management fee from 0.37 to 0.25, and then they obviously incur the TERS that were happening within the fund. So a lot of that drop is actually the management fee, and then there's a slight improvement in terms of the total expense ratio of those ETFs. Now, the then question is, now that the management fee is at 25 points, little over half of the total expense ratio. Yeah, I was chatting with Vicky Tag earlier in the week. She heads up indexation, and they are always cognizant of fees, and one of those wriggle rooms is going to be on their management fee, and that's a size. We've seen it in the US as an ETF gets more and more assets under management, so they slowly eke that fee down to the point that we now have a couple floating at around the 0.03, 0.04%. A question coming, do I hold other ETFs as well? I do. If you go to simonbrown.co.za, you will see my vanity website. You'll see my holding there. This is my core ETF holding, and it's what I put most new money in. It's the one I buy on a monthly basis as well. Can you email them? No. So you don't email Ashburton, don't email Standard Online Share Trading. You're going to need to do this via the elective process. It's smooth, it's easy, no real complexities there. So that in of itself works exactly as advertised. Folks, if you've got more questions, drop them in the Q&A box. So the events we do, it's Mondays is Market Standard, Wednesdays is Know Your Platform. If there's something in particular that you want me to delve into on Know Your Platform, drop me an email, simon@justonelap.com, one as an O-N-E, or you can tweet me at simonpb. Fridays, we're doing Fun Tech Fridays, and we're shifting it slightly. We're going to look at some fundamentals, some technicals, we'll look at unit trusts, we'll look at ETFs, so it's still coming through. And of course, all the videos go onto the YouTube. Head over to YouTube, search Standard Online Share Trading, and you will find all the videos available there. Question coming, if I don't like the change, what are my options? And you're saying that in this case, you don't have an objection, but sort of, speaking broadly, if you don't like the change, your option is to vote against it. And then assuming that they get the majority who do like it, then your option is ultimately to exit the fund, and that might have tax implications. Quickly on this point, this will not be a tax event. In other words, you won't be deemed to have sold. Your entry prices will remain, and you won't be deemed to have sold and bought into the new fund, so it's not a tax event. Shabir, you're asking about dividends. Yep, dividends will continue to flow. They pay on a quarterly basis. What will happen is that the ETFs underlying it, the 7 ETFs will pay their dividends. They will accrue into Ashburton, and Ashburton will then pay those dividends out to the unit holders who hold it on the last day to trade. So dividends will continue to flow. That will all continue to happen. Essentially, aside from the fact that they are required to notify and to ballot, and I think that's a good process. The change the change is absolutely tiny. It just means that we are going to be 0.18% richer every year because of the slightly lower fee in the exchange traded fund. Do I own the S&P 500, any S&P 500 ETFs? On the JSE, I don't own indirectly because, of course, it sits within this Ashburton, but I don't own them directly. And there's a lot of debate around this. So the Ashburton 1200 is my preferred, but let's make no bones about it. There are others. There are the MSCI, there's a Satrix and a Signia iTrix on the MSCI developed markets. There are 3, am I correct, or is it, I think, 4 S&P 500s, one from One Invest. We've also got Satrix, Core Shares, and Signia. We've got 1200 here, and then, of course, Core Shares has their Global Dividend Aristocrats. Those are all global ETFs. And, over the next 10, 20, 30 years, one of them will do better and one of them will do worse. And I honestly don't know which one it is. I like this because it's slightly more globally diverse, and because it also brings in a little bit of direct emerging market exposure. In the last sort of couple of months, in fact, I was checking data to August of last year, the S&P has beaten the Ashburton 1200, but there have been points in that 10-month period where it's been the other way, and the Ashburton has beaten the S&P. The S&P right now obviously winning, and that's because of its higher tech focus. It does have a higher tech weighting. And then Shabir, you were asking, what is the best tech ETF on our market? So I actually did a webcast on it. Head to YouTube, you'll find it there. Search Standard Online Share Trading. And weirdly, it's not the NASDAQ, and it's not the Fourth Industrial Revolution, and it's not the S&P. One Invest actually has a S&P tech fund. And what they do is they take the S&P 500 and they pull out the tech-only stocks. So they take the 78 tech stocks, and that means that fund is 100% tech. Interestingly, Amazon is not considered a tech stock. Amazon is what is Amazon? And I forget now. I think it's considered is it a comms or something? So Amazon is not in the S&P tech ETF, but the NASDAQ 100 is actually only about 40-odd% tech. The S&P 500 and the MSCI are respectively around 20% tech. And the Fourth Industrial Revolution was surprisingly light on tech at also around 20 or 25%. But Shabir, if you head to YouTube, there's a webcast I did on the different tech ETFs on the JSE, and that raises a good point. Is always dig under the hood. Make sure you know what you're getting. Make sure you're happy with what you're getting, because you go and buy a NASDAQ, and you think it's tech, and there's a lot of tech in the NASDAQ, but it's only about half. And you know what, don't get me wrong, the NASDAQ is at all-time highs and done spectacularly well. I'm not saying it's a problem. I'm always just saying, know what you got, know what you say. Question, how do you sign up for the other different events? So there should have been a reminder email sent out an hour ahead of this webcast, and in there will be all the different links that you for the Monday, the Wednesday, and the Friday, and you register for each separately. And if you can't find that, drop me a mail. I will send you the links. Another question. I was about to hang on a sec. Guy, please explain a total return fund. For example, the momentum from ABSA, the new fund's equity momentum ETF. Guy, I love how you put your question. If I carried on reading, I wouldn't have had to try and remember exactly what it was. Whereby your quantity of ETF holding does not increase, but dividends are reinvested. How do I see value add? That's a great question. So most ETFs, the vast majority, pay out their dividend, and you then receive the dividend, and you can do with it as you want. You can buy the ETF, you could buy a different one, you could go and take someone for dinner. The total return ETF says, no, we're going to take that money and reinvest it back into the different fund, into the different stocks. So let's take, for example, the momentum one. They receive cash from dividends. Normally they would pay you, and let's say that ETF is trading at, let's say $50. I'm just using that as a random number. And let's say they paid a R1 dividend. What would happen is the value of the fund would decrease from 50 to 49. So on that LDT, the last day to trade, the ETF falls from 50 to 49. You're in exactly the same position. You had a 50 Rand ETF. Now you've got a 49 Rand ETF and R1 of cash. The total return says, no, we're not going to pay you. We're worth 50, but instead of giving that cash to you, Guy, as a holder, we're just going to put that cash back into the various different shares. So in essence, it's sort of like an automatic reinvestment for you. It doesn't boost the fund, I suppose, because the same principle applies as those different stocks that make up that ETF are paying the dividend. They fall by the dividend amount. So there's no immediate net gain or loss. You're in the same position. What a total return fund does, and I like them, and it's because I don't need income at this point. Well, no, I take that back. I need income, of course, so I've got habits. I don't need income from my investments at this point. So it saves me the bother and the cost of having to reinvest those dividends. As a portfolio gets bigger and dividends get more chunky, that becomes less of an issue because your dividends exceed thresholds. But when it's if you've got a small portfolio and you're getting $100 dividend, how do you reinvest $100 dividend? I mean, truthfully, you hang on to it until you can put more cash in or get more dividends. The total return just does that automatically for you. Again, a good point is know what your funds are. Know if they are total return or not, and if you like that or not. There's pros and cons, and I'm seldom going to say that's wrong. It's just a case of know what's under the hood, know how it works, and know if you're happy with it. Guy, absolute pleasure. EJ, always a pleasure. Ladies and gents, that's us for the day. Somehow I always manage to hit the time perfect-ish. We'll park it there. We'll be back again Monday. Everyone have a safe weekend. Craig, all the best. Cheers, everyone.